The housing market is going through a shift right now that almost nobody is talking about. And whether you're looking to buy your first home, thinking about selling, or just trying to figure out where home prices are headed, what happens over the next few years is going to catch a lot of people off guard. In this video, I'm going to break down the biggest shifts coming to the housing market, and more importantly, what you actually need to do about each one. Okay, here's the first shift. We're in the middle of what I call an affordability reset. Right now, the average home buyer is spending over 30% of their income on just their mortgage payment. Back in 2019, that number was only 21%. Since the year 2000, the median home price in America has gone up 177%. Incomes has only gone up 92%. So if you adjust this for inflation, incomes have only gone up about 8.5% in 25 years. Home prices, they're up 56% in real terms. That gap is why the average first-time home buyer is now 40 years old. That used to be 28 back in the 90s. Now here's where people get it wrong. They hear those numbers and they think, okay, prices have to crash. But this is not 2008. In 2008, the crash happened because of homeowners, bad loans, no equity, people who never should have approved in the first place. Today, 45% of homeowners with a mortgage owe less than half of what their home is worth. Only 3% are seriously underwater. Lending standards after 2008 were completely overhauled, and for a good reason. The risky loans that blew up the market, they basically don't exist anymore. And on top of that, we are short over 4 million homes in this country. That's a decade plus of underbuilding that you can't fix overnight. So if it's not gonna crash, how does it get better? Slowly. Here's what the data is showing us right now. Incomes are finally starting to grow faster than home prices. Home prices nationally are forecasted to grow maybe 1 or 2% this year, 2026, which is well below the pace of wage growth. When you adjust this for inflation, real home prices actually have been declining for 2 years straight. That's the reset. And I'm already seeing this play out locally. Right here in Katy, Texas, home values are actually down about 3 to 5% year over year. That's not a collapse. That's a market finding its footing. And for buyers who are ready, that's actually opportunity. So here's the move. If you're waiting for some magical crash to swoop in and then buy, you could be waiting forever. And the whole time, you're paying somebody else's mortgage through rent. So what's the smart play? Buy within your means now while sellers are flexible, while inventory is up, and while you actually have negotiating power for the first time in many years. And the people who understand that, they're the ones building wealth while everyone else waits on the sidelines, getting absolutely nothing. The second shift is something I see in my data every single day. The profile of who's actually buying homes now has completely changed. The share of the first-time home buyers in the market, a record low, just 21%. That means nearly 8% of homes being bought right now are being bought by people who already own a home. So if you're a first-time home buyer and you feel like you're competing against people with more money, more equity, and more flexibility, you are. And that's not in your head, that's in the data. But here's the shift inside the shift. 30 to 39-year-olds bought more homes than any other group last year. 26% of all purchases. And 20-somethings jumped from 14%, nearly 19% in just one single year. Millennials are now deep into their peak buying years. They're starting families, getting promoted, paying down debt, and they're done waiting. The millennial home ownership rate ticked up 55% last year. Still behind where boomers were at the same exact age, but the momentum is real and it's building. This is a demographic wave. 72 million millennials are moving through the housing pipeline right now. That demand doesn't just disappear because mortgage rates are at 6%. And here's how they're making it work. 21% of young buyers used a cash gift from a family member to help cover their down payment. Another 18% moved back in with family specifically to save before buying their home. And what about multi-generational home buying? record high. 17% of all homeowners last year were multi-generational purchases. These are families pooling resources and buying together. The number one reason, not caregiving, cost savings. 36% said that's why they did it. They're combining incomes, they're sharing expenses, and qualifying for homes they could never touch alone. Okay, here's the third shift. It's called the lock-in effect. This is the shift that explains why you're not seeing as many homes on the market as you'd expect from the past. And it's going to shape this market for many years to come. Here's what happened. During 2021 and 2020, millions of homeowners locked in their mortgage rates around 3%, some even lower. And when rates shot up to 6 or 7 or almost 8%, these homeowners looked at the math and said, I'm not going anywhere. If you've got a 3% rate on a $400,000 home, your payment is around $1,500 a month. If you sell that home and buy the same house at today's rate, you're looking at closer to about $2,500. That's $1,000 more every month for the exact same box. And this isn't just a small group. Right now, over 51% of all outstanding mortgages have a rate at or below 4%. And that research shows this lock-in effect prevented an estimated over 1.7 million home sales between 2022 and 2024. That's why inventory has been tight, and that's why prices have stayed so stubborn. But here's the shift inside the shift again. For the first time in 5 years, the share of homeowners with rates above 6% has officially passed the share with rates below 3%. 21% are now above 6. Only 20% are below 3. That crossover matters because those homeowners above 6%, they're not locked in. If they need to move for a job or divorce or a growing family, the math isn't punishing them. They can now sell and buy at a similar rate without doubling their payment. That is critical to understand. That gap between locked in rates and the market is now narrowing every quarter. The handcuffs are loosening. Forecasters at Fannie Mae expect rates to settle near the 5.9% by the end of this year. Every tick down means more sellers re-enter the market. So what does that mean for you as a buyer? Right now, you're in a sweet spot. Inventory is climbing. Active listings are near pre-pandemic levels. So for the first time, sellers who are listing today are motivated. They're offering concessions, they're negotiating. But here's what I want you to understand. As the lock-in breaks further, and it will break, more sellers come to that market. So the window where you have rising inventory and less competition, that's right now. Not next year, not when rates hit 5, right now. Shift number 4 is one that makes people very angry. And honestly, I get it. You've probably heard that big corporations are coming in, buying up all the houses. Here's what's actually happening and what it actually means for you. In 2025, investors bought about 27% of all single families sold in the United States. That sounds terrifying until you look at who those investors actually are. 87% of those investors own single family homes already and are held by small mom and pop investors, people who own between 1 and 5 properties, a dentist who bought a duplex. That's the vast majority. The big Wall Street firms, the one with 100+ homes, they own less than 1% of all single family homes in America. That's the real math. Now, does it mean that it won't affect you? No, because there are still specific markets where institutional money is heavily concentrated. For example, Atlanta. Institutions own 27% of the single family rental stock. Jacksonville, Florida, 22%. Charlotte, nearly 20%. If you're buying in those Sunbelt metros, you're going head to head with corporate money at the entry level price point. Here's the part of the institutional land grab that most people aren't even paying attention to yet. It's called build to rent communities. These are entire neighborhoods of brand new single family homes built from the ground up that will never be for sale. They're rental only. Over 150,000 of these units are either under construction or in development right now across the entire country. That number was basically 0 10 years ago. And President Trump's executive order to restrict institutional investors, it specifically exempts built to rent. So you have to understand that carve out. So even if a ban goes through, these communities keep growing. The Sun Belt is ground zero Texas, Florida, Arizona. For renters, this can actually be a good thing. More options, newer homes. But for buyers, this is supply that's being built that you will never get to own. It adds housing, but it doesn't add inventory for sale. So here's how to navigate this. First, stop blaming Wall Street for the entire housing crisis. The math doesn't support it. The real issue is we're short over 4 million homes. Second, check the investor concentration in your specific zip code before you buy. It matters, neighborhood by neighborhood, not nationally. And third, if you're buying at the entry level in the Sunbelt market, move fast when you find a home, because the competition isn't just other families anymore. It is the capital, and capital doesn't get emotional. It just runs numbers and buys. And this takes us to our shift number 5, the geographic shuffle. This is reshaping entire regions of our country, and it's happening faster than most people even realize. Now let's start with the engine behind all of this. It's called remote work. We all know when it happened. Despite all the return to office headlines, the numbers tell a different story. Among workers whose jobs can be done remotely, 52% are hybrid and 27% are fully remote. I see it all the time on our mortgage applications. Only 21% are back in the office full time. That means that 80% of knowledge workers have some flexibility in where they live. And when you give people that flexibility, they move. They chase square footage, they chase affordability, they chase better schools. And they're not going back. 66% of companies now offer location flexibility. Hybrid job postings grew from 15% in 23 to 24% by the end of 25. Now, for the last 5 years, the story was simple. Everyone's moving to Texas and Florida, and that was true. Texas added 2.6 million residences since 2020, more than any state in the entire country. But here's the shift inside the shift again. That wave is slowing down. Net domestic migration into Texas dropped from 222,000 in 22 down to 67,000 in 25. So who's winning now? North Carolina just passed Texas in net domestic migration. 84,000 people. South Carolina was the fastest growing state by that percentage. And then there's Idaho and secondary markets that are becoming primary destinations. Cities like Raleigh, Boise, Nashville, Columbus, they're seeing the next wave of what Austin and Tampa saw just 3 years ago. But here's what I want you to understand. The frantic pandemic era rush is cooling. Texas still added over 1,000 people a day last year, but the pace is normalizing, and that's actually healthy. So here's the play. If you're in a market that already boomed, Houston, Austin, Tampa, you're moving into a more balanced environment. Use that to your advantage. Negotiate. You have leverage finally that you didn't have 2 years ago. If you're eyeing a secondary market that's still early in a growth curve, places like Raleigh, Boise, or right here in Fulshire, understand that the migration engine hasn't stopped. It's just diversified. And that brings me to the 6th and final shift. I call it the process revolution. So let's start with how people shop for homes today. 82% of Americans are using AI tools to research housing information. Everything from searching listings to estimating payments to comparing neighborhoods. And that number is going to grow. 39% of active buyers are using AI directly inside of their home search. Virtual tours, mortgage calculators, property value checks. Platforms like Zillow and Realtor.com lets you type in exactly what you want. No more clicking through 20 filters. Buyers today show up to their first showing having already researched the neighborhood, the school ratings, the flood zone, the comps, and the estimated payment. You're more informed than any generation of buyers before you, so you have to use that. Now, here's the one most buyers still don't fully understand. The rules around how real estate agents get paid changed in August of 24, and the ripple effects are still playing out. Here's the short version. Sellers used to automatically pay both their agent and your agent as a buyer. That's no longer the default. Before you even tour a home, you now have to sign a written agreement with your buyer's agent that spells out exactly what they charge for their services and what services they provide. Did commissions actually drop? Not really. The average buyer agent commission is sitting at about 2.4%, which is roughly where it was before the settlement. Most sellers are still choosing to cover buyer's agent fees as a concession. But here's what did change. It's the transparency of it. You now know exactly what you're paying and exactly what you're getting. And it's forcing agents to get better at their job, which is a good thing. So what's the play here for you? First, interview your agent. Ask them about their experience. How do they differ from the AI tools out there? And let their answers be clear. And if it's not, find somebody else. Secondly, use the technology. Get your pre-approval from someone who actually knows what they're doing. All these tools allow you to do your homework. So now you're going to be more informed about how to better position yourself, how to negotiate. And third, don't confuse the information with expertise. AI can tell you what a house is worth, but it can't tell you that the foundation has a crack, the seller is desperate, or a better deal is about to hit the market next week. That's where a great agent and a great lender team earn their fee. The process is faster, more transparent, and more in your control than it's ever been. But the people who win in this market are the ones that combine the technology with the right team. That's not old school. That's the new playbook. So what does all this mean for you? 6 shifts. Let me boil it down to 3 main principles. Number 1, stop waiting for the perfect time. There's no crash coming to save you. The reset is already happening, slowly, quietly, month by month. Every year you sit on the sidelines, you're paying someone else's mortgage and building zero equity. Ready beats perfect every time. Number 2, know the full cost before you buy. Buyers obsess over just the interest rate and completely ignore taxes, insurance, and structure, maintenance, HOA. Your mortgage payment is only half the story. We have to underwrite the entire thing. Otherwise, you get surprised at closing, which is not a good thing. And number 3, play by the new rules. Families are pooling money. Commissions are negotiable. AI gives you more data than agents had a decade ago. The people winning right now aren't waiting for the market to get easier. They're getting smarter. And that's what you need to do. Now that you understand what's actually happening in this market, how do you actually navigate it? Especially if you're buying your first home. So click this video here. I actually put together the most comprehensive first-time home guide you're ever going to find. I'll see you there.